The UK financial system is packed with legitimate cheat codes designed to keep your money completely out of the taxman's hands. Today, we're breaking down the ultimate financial allowance guide for 2026. We're going to be tackling ISAs, SIPs, personal savings allowance, and dividend rules. But most importantly, we're going to be talking about how you can legally maximize your tax-free cash. So let's talk about the absolute foundation of UK wealth building, the individual savings account, or ISA. Right now, the overall ISA allowance is £20,000 a year. You can put this into a cash ISA, a stocks and shares ISA, or a lifetime ISA. And for every single penny of capital growth, interest, or dividend, it's totally tax-free. Now, you need to maximize your cash ISA now, because it was announced in April 2027, the cash ISA limit drops to just £12,000 a year for anyone under the age of 65. Now, your total ISA limit does stay at £20,000, but you can only allocate £12,000 to a cash ISA. This is part of the government's plan to get more UK individuals investing into equities and stocks. Any money that you put into the cash ISA above the £12,000 limit before April 2027 remains fully protected and tax-free. With this one, there is no carry forward rule. You either use it or you lose it. Now, just a quick tip, if you're aged between 18 and 39 and you are saving for your first house, you need to use a LISA. Now, with the lifetime ISA, you can put in a maximum of £4,000 a year. The government will then add on 25% bonus on top, which if you put the max in, is £1,000 every year. Now, unlike the old Help to Buy ISA, a LISA can be used to directly pay for the deposit of your house. This is extremely powerful, and it means that you're not having to save up extra money for the deposit as well. ISAs are one of the most powerful ways to build wealth over a long period. You essentially get a pot where you can put money in. It will grow tax-free forever, and you can take that money out whenever you want. If you have the opportunity to put into an ISA, whether that's a cash ISA, a stocks and shares ISA, or even a lifetime ISA, start now. The sooner that you start, the more money that you'll make over the period of time. ISAs are completely unique products to the UK, and across the pond in America, they don't have the opportunity like we do, so take advantage of this. Before we move on to the next point, I am on a mission to hit 1,000 subscribers before the end of the year. If you're finding this or any of the content I post helpful, consider subscribing and supporting the channel. Now, section number 2 on this list, and one of the most explosive ways to get free money from the government, you need to be looking at your pension, specifically a SIP or a self-invested personal pension. Now, the annual allowance for a SIP is a massive £60,000 a year. This means that you or your employer can contribute up to £60,000 a year or 100% of your earnings, whichever is less. If you earn £65,000, you can only commit £60,000 into your pension. But the powerful thing is, a SIP or a pension is like a reverse tax machine. If you're a basic rate taxpayer and put £80 into your SIP, the government automatically adds £20 on top, making it £100. If you're a higher rate taxpayer, you get a massive 40% relief overall, meaning that a £100 pension contribution effectively only costs you £60. Now, unlike an ISA, if you didn't max out your pension over the last 3 years, you can use the carry forward rules. This means you can legally dip into that unused allowance from the past 3 years to supercharge your contributions this year. Now, not many of us will earn over £100,000 a year, but if you do, this one's for you. Earning between £100,000 and £125,140 means that you're hit with a brutal 60% stealth tax. This is because you lose your personal allowance. Now, a massive way to combat that and get a rebate from the government is to actually put money into your pension. By allocating money into your pension over that year, you essentially reduce your pre-tax profit, meaning the government have to give you money back for the money that you've put into your pension. It's one of the single biggest ways that the rich or the high earning societies make sure that they pay less tax. And that's why there's so much money in pension funds. Next, we need to talk about money held outside of these accounts. And this is where many people are getting caught out in 2026. First is your personal saving allowance. If you're a basic rate taxpayer, you can earn £1,000 in interest before you have to pay tax. If you're a higher rate taxpayer, this drops down to £500, and for additional rate taxpayer, that's £0. Now, with interest rates sitting where they currently are, it's not uncommon to be hit with an unexpected tax bill. Next up is dividend allowance, and this is frozen at a tiny £500. Any dividend income made from an individual outside an ISA over £500 is taxed. And remember, the basic and additional rate for dividend tax has gone up. Currently, the basic dividend tax is at 10.75%, and the higher rate is a steep 35.75%. If you're currently trading investments outside of an ISA, but you have the opportunity to max out your contributions, you need to do what's called bed an ISA. This essentially means that you sell the shares that are outside the ISA, take the money and buy them within the ISA. By doing this immediately, you essentially don't lose out on any dividends. And because it's sat in an ISA, it's protected forever, and all of the money you generate is totally tax-free. Now, while you're shifting money between accounts, you do need to be aware of the Financial Services Compensation Scheme. In the UK, if a bank or building society goes bust, the individuals that bank with that institution are entitled to compensation. Now, currently, the compensation limit for most bank accounts in the UK is £120,000. This means if you have £120,000 in a bank and they're part of the compensation scheme and they go bust, you're covered for £120,000. But you need to be aware the difference between banking institutions. For example, Halifax and Lloyds are part of the same financial institution. This means if you have £120,000 with Halifax and £120,000 with Lloyds, you're still only covered for 120, not the full 240. Now, the following takes 10 minutes. Go and check which banks are part of the same financial institution. By doing this, if you have more money than £120,000 per institution, consider moving your money into a different institution or bank. By doing this, you protect yourself from the potential fallout of a bank crisis, like what happened in 2008. In order to cover every way to save money and keep more money in your pocket and away from the tax man would make this video probably 10 hours long. The simple strategy is on screen now. Number 1 is fund your emergency pot and keep it inside a cash ISA to protect it before the 2027 limit drops down to £12,000. The second is to max out your employer pension match. It's literally 100% immediate return on your money. Number 3, use the stocks and shares ISA for long-term investments so you can completely ignore the shrinking £500 dividend allowance per year. Number 4, if you are a high earner, use your SIP strategically. Drag your taxable income back below the £100,000 threshold and restore your personal allowance. And finally, number 5, keep your cash piles scattered across different banking licenses to make sure you're always covered by the £120,000 Financial Services Compensation Scheme safety net. The rules change extremely fast, and when we talk about financial security, one moment it could be correct and the next moment it could be out of date. By mapping out your finances and where you're spending your money and how you're ring-fencing yourself to ensure that you spend less money on tax will save you in the future. Drop a comment below. Have you maxed out your ISA for this year? If you have, tell me how you did it. As always, my name's David, and thanks for watching.